Microsoft delivered what looked like a near-perfect earnings report on the surface. Revenue, profits, and Azure growth all beat expectations across the board, and yet the stock collapsed as much as 12% intraday, a historic sell-off that erased a market cap equivalent to an entire Costco in a single day. This wasn't just one of the largest one-day drops in Microsoft's history. It felt more like a market-wide referendum on the return on AI investment. Beneath the headline numbers, a deep crack of fear has quietly opened up. Welcome to Deep Dive Stock Earnings. Microsoft is trapped in a bizarre financial paradox. Customers are placing orders at record speed. Profits are surging, yet investors are heading for the exits. Why can blockbuster earnings restore market confidence? Today, we cut through the surface-level prosperity of this report. Even though Microsoft posts double-digit growth in both revenue and EPS, and Azure growth remained elevated at 39%, the capital markets chose to vote with their feet. This massive destruction of market value reflects investor skepticism toward how much of Microsoft's reported performance is being enhanced by accounting gains tied to its OpenAI investment. The market is no longer focused on headline profits alone, but on when and if these enormous investments can translate into real, sustainable, and non-adjusted free cash flow. At its core, this is a crisis of trust driven by earnings quality. A portion of Microsoft's net income comes from mark-to-market gains on its OpenAI stake classic paper profits. Once you strip those out, the core businesses are still growing, but the pace of cost expansion is rising even faster. That imbalance is what's making investors uncomfortable. The real pressure point for the market lies in Microsoft's seemingly bottomless capital expenditures. Quarterly CapEx reached $37.05 billion, pushing the annualized run rate beyond $150 billion. More importantly, nearly two-thirds of that spending is flowing directly into rapidly depreciating hardware assets. This is no longer traditional infrastructure build-out. It's a relentless hardware treadmill, where maintaining competitive positioning requires continuous and massive reinvestment. An annualized $150 billion spend means Microsoft must funnel the majority of its free cash flow straight back into data centers, and these assets depreciate incredibly fast, with very real technological obsolescence risk. Whether this level of investment can generate a sustainable return on capital is the single largest shadow hanging over the stock. Despite strong Azure demand, Microsoft has openly acknowledged that demand still exceeds supply. Power shortages and constrained access to high-performance chips have created real physical bottlenecks. As a result, Microsoft's revenue ceiling today isn't defined by customer appetite. It's defined by how fast it can build data centers and secure sufficient power capacity. This puts Microsoft in a highly constrained operating mode. In the past, it could rely on software iteration to unlock operating leverage. Now, it's operating like a heavy asset, low turnover business, where growth is capped by physical infrastructure. That fundamentally limits how much valuation premium the market is willing to assign. Within Microsoft's $625 billion backlog, there's a critical detail investors can't ignore. Roughly 45% of those contracted orders are tied to a single partner, OpenAI. That means nearly half of Microsoft's future backlog depends on a startup that is still heavily loss-making and reliant on external funding. This level of customer concentration introduces significant financial fragility. Put simply, there's a concern about a circular funding dynamic. Microsoft provides capital and cloud resources. OpenAI converts those resources into cloud spending, and the revenue flows back to Microsoft. If OpenAI's future funding becomes constrained or commercialization falls short, a large portion of that $600+ billion backlog could face impairment risk. To reduce dependency on external hardware vendors and protect margins, Microsoft is accelerating vertical integration. The Maya 200 and Cobalt 100 chips are central to reclaiming hardware control. Internal performance metrics are now focused on tokens produced per dollar and per watt. Microsoft's goal is to cut total cost of ownership by more than 30% and retain more economic value in-house. This is Microsoft's silicon sovereignty strategy. The company recognizes that if compute costs remain controlled by third parties, AI margins will ultimately be captured by hardware suppliers. Custom silicon isn't just about technical independence. It's a direct counterattack on the cost structure. Microsoft's strategic focus is shifting from Copilot as an assistive tool toward autonomous AI agents. In this vision, Agents become the new application layer. AI no longer just suggests actions, it executes them. From booking travel and writing code to automating entire business workflows, this marks Microsoft's attempt to transform AI from a feature into a core productivity engine with scalable monetization. This represents a shift from nice-to-have to business-critical. Only when AI can independently generate economic value will enterprises show sustained willingness to pay by betting on agents. Microsoft is trying to break through the current monetization bottleneck and convert usage into durable, large-scale revenue streams, a necessary step to justify its valuation multiple. A more subtle financial risk lies in the severe mismatch between asset duration and contract duration. Data centers and servers are depreciated over 6 to 15 years, while the average contract term in Microsoft's backlog is just 0.5 years. This leaves Microsoft locked into long-lived fixed assets, while customer renewal commitments remain relatively short. In the end, Microsoft is walking a narrow road where outsized rewards coexist with elevated risk. It's making aggressive bets on future growth, and the stock's violent volatility reflects the market's ongoing reassessment of that uncertainty. Do you see this pullback as a buying opportunity or as a warning that the bubble is accelerating? Let me know in the comments. I'm Deep Dive Stock Earnings, and I'll see you in the next one.